Wow. Looking at this stack of research you've brought, it's pretty clear what the big question is. How did the foreclosure crisis get so big and cause so much damage? And that's what we're going to try to figure out today. We're diving deep to uncover the main reasons why it happened.
Yeah, and it's a complicated story, for sure. The full report that we're using today,
Hmm.
it combines so much information. You've got serious academic research reports from people on the ground, and then all that government data. So
Right.
even though we're focusing on the report's analysis today, it's important to remember all of that evidence is behind these conclusions.
Exactly. We're not just skimming the surface here. The goal is to really understand how things worked. Maybe even uncover those hidden connections between what was happening in the market, the regulations or the lack of them, and how lending practices changed over time. So where does this story really start? The report points to some early signs back in late 2006.
It's interesting. Even before the crisis was making headlines, there were some big failures, maybe not as well known. But significant Own-It Mortgage Solutions and Sebring Capital, they both went under. And the reason, a surprisingly high number of what are called early payment defaults.
Early payment defaults. Now, for those of us who don't speak mortgage every day, what does that even mean and why was it so important for these lenders?
Basically, it means borrowers start missing payments really soon after getting the loan. And the reason this can be a disaster for lenders, especially mortgage banking firms, is that if a loan defaults that quickly, they often have to buy it back from investors they've already sold it to. So for firms that aren't sitting on a ton of capital, a bunch of buybacks happening all at once, well, that can lead to a solvency crisis really fast.
Yeah.
It's like this instant financial shockwave.
So these failures, maybe they weren't front page news at the time, but they were like a warning sign, a canary in the coal mine, signaling that there were bigger problems brewing in the mortgage market.
That's a great way to put it. It was an early signal that something was wrong, fundamentally wrong, with some of these new loans.
And if we move ahead a bit to 2007, it looks like things got a lot worse.
Definitely. By early 2007, the report shows record numbers of foreclosures being started by lenders. What's really worrying is that this jump in foreclosures actually happened before we saw record numbers of loans that were 90 days or more past due. What that tells us is that people were moving from having trouble making payments to full-blown foreclosure really quickly. It was speeding up.
And that just kept going into 2008. The numbers are pretty shocking.
Totally blew past all previous records. That's what the report says. By the second quarter of 2008, the rate of new foreclosures starting, it had more than doubled the high point from before 2006, hitting 1.08% of all mortgages. At the same time, the rate of seriously delinquent loans, those 90 days or more past due, well, that followed a similar path. More than doubled its 2005 record, reached 2.09% by the third quarter of that year.
Now, the report mentions this interesting thing, a pause in the rate of new foreclosures starting in the third quarter of 2008. What do you think caused that?
That temporary dip. Probably a few things combined. Some lenders put temporary stops on foreclosures, and they started working more with borrowers who were struggling, trying to find solutions to avoid foreclosure. But, and this is a big but, the core problem.
Yeah.
The number of loans that were seriously delinquent, that number kept going up. So it wasn't like the problems in the market were actually being fixed.
Right. It was like hitting pause on something that was going to happen anyway.
Yeah.
And sure enough, by the first quarter of 2009, the rate of new foreclosure starts. It surged again, hit a new peak. It really shows how unstoppable this crisis was becoming.
And it's important to remember, this crisis didn't hit everyone the same way. The report makes it clear that foreclosure rates varied a lot, depending on the type of mortgage and where you were in the country.
So let's break down those differences. The subprime mortgage sector really jumps out in the report, doesn't it?
It really does. Yeah. And not in a good way. The foreclosure rates for subprime loans were way higher, about 9 times the rate of prime mortgages since 1998. And if you look at the increase in subprime foreclosure starts after 2006, it's in one of the exhibits. It's just a huge, rapid increase.
And it wasn't just subprime. Other loan types that were considered riskier, those also grew a lot in the years leading up to the crisis.
That's fascinating. The whole makeup of the mortgage market shifted between 2003 and 2006. Subprime loans, Alt-A loans, those are the ones with less strict documentation. And home equity loans, or HELs altogether, they grew to be 48% of all new mortgages. That's almost half. To give you an idea, subprime went from 9% to 20%, Alt-A from just 2% to 13%. And HELs, a lot of times used as what were called piggyback loans, so people could avoid bigger down payments, those went from 5% to 14%.
And within those categories, the specific features of the loans mattered, especially those adjustable rate mortgages, or ARMs.
Totally. The data shows that ARMs had a bigger impact on subprime foreclosures. ARMs were about 48% of all subprime loans. but they made up a whopping 73% of all subprime foreclosure starts. So that adjustable interest rate, it seems like that was a major factor in the problems within the subprime market.
And looking at different parts of the country, the impact was uneven. The sand states got hit particularly hard, didn't they?
Yes, California, Arizona, Nevada, and Florida, they're often called the sand states because of how fast their population and the housing markets were growing. They saw the biggest jumps in foreclosure starts by the end of 2006. What happened in those states?
Right.
It really influenced the national foreclosure rate. The industrial Midwest saw increases too, but not as severe. And then the central and southern plains states, they actually had higher foreclosure rates even before the crisis started. They saw smaller increases and eventually ended up with rates below the national average.
Okay, so we've looked at the timeline and the areas that were hit hardest. Now the report gets into some of the research that was done to challenge those simple explanations that were going around about the crisis. Let's start with this ruthless default idea.
So the option-based theory of mortgage default, what that says is that homeowners will basically make a cold financial decision to default on their mortgage. They'll just hand the house back to the lender. When the value of their home drops below what they still owe, they're treating it like a put option on the property.
But the report suggests that the actual data doesn't back that up as the main reason for all those foreclosures.
Right. Well, negative equity, owing more on the house than it's worth, is definitely a big factor, and it's strongly linked to foreclosure. The data from the past tells us that most people don't just default because of this cold calculated decision. For example, the report mentions that in the early 1990s, when the housing market went down, only a small number of homeowners who were underwater on their mortgages actually ended up in foreclosure.
Another common explanation you hear is borrower illiquidity. Things like losing a job or going through a divorce, stuff that makes it impossible to pay the mortgage. What does the research say about how important those factors were?
It seems logical that something like a job loss or a big life change could lead to foreclosure.
Right.
But the research has found a weaker link between those individual trigger events and foreclosure rates, especially when you compare it to how strong the link is between negative equity and foreclosure. The report thinks maybe this is because it's hard to get really detailed information about the finances and personal situations of individual borrowers.
And the foreclosure surge in the late 2000s, it had some unique things about it, things that make it different from other times the housing market went down. Like that example with Massachusetts is interesting.
It is Massachusetts. They had a big spike in mortgage delinquencies during the 2001 recession. But then, surprisingly, the number of foreclosures stayed pretty low. That's because house prices were still rising quickly. So borrowers had other options, like selling or refinancing. But in the late 2000s, even though prices weren't dropping as fast in some areas, foreclosure rates were much, much higher. Researchers think the big difference was how much subprime lending had grown and how underwriting standards had changed.
And even back in 2005, 2006, when it was pretty clear the housing market was getting overheated, a weak economy didn't seem to be the main driver of those rising subprime delinquencies.
Exactly. Studies found that how fast house prices were going up, that was a much stronger factor in explaining those subprime delinquency rates during that time, more so than employment levels. So this supports the idea that what was happening within the housing market itself and the types of loans being offered, those were at the heart of how the crisis developed.
Okay. Let's look at those risky loans themselves and how the seemingly stable market conditions at the beginning, they kind of hid how dangerous those loans really were. Investor loans grew a lot in the years before the crisis.
Right. Investor loans more than doubled between 2001 and 2005, ended up being more than 1 out of every 6 home purchase loans. And in the markets where house prices were going up the fastest, that share was even higher. So you have these investors often just focused on making money. As that price growth started to slow down, the potential for what we talked about before, that ruthless default, well, that would naturally increase.
And until around 2006, those rising house prices, they were almost like a safety net, even for these riskier loans.
Exactly. Borrowers could often refinance or sell their homes for a profit. That hid how risky a lot of those subprime mortgages really were, even with prepayment penalties. A lot of subprime borrowers were prepaying their mortgages, which tells us they were using that as a way to deal with payments that were getting too expensive, not just trying to get a lower interest rate.
It's like it creates its own problem. The report even suggests that all this risky lending, it might have actually contributed to those rapidly rising house prices.
That's a key point, making it easier for more people to borrow more money to buy homes, often without having to meet strict requirements. That increased availability of risky credit, it probably boosted demand and let people bid higher on properties. And that, of course, pushed house prices up, at least for a while, creating this illusion that these loans weren't so risky. It was like a house of cards built on the idea that values would just keep going up forever.
And as the market got flooded with these higher risk loans, it looks like those traditional safeguards, the underwriting standards and quality controls, those started to weaken a lot.
The numbers are pretty startling. The combined market share of subprime Alt-A and HELs, all those riskier loan types, they jumped from only 16% of all new mortgages in 2003 to a huge 48% by 2006. And then there was this rapid growth in what were called non-traditional mortgages, things like interest-only loans and option ARMs. Those let borrowers make really low payments at first. They made up almost 30% of the whole market by 2006.
And along with this change in the types of loans, the report shows how a lot of the checks and balances in the lending process, those seem to disappear.
Yeah. There's a lot of evidence that underwriting standards got looser across the board. Lenders weren't checking income as carefully. They were allowing higher debt-to-income ratios, requiring smaller down payments with lower loan-to-value ratios, and they were approving borrowers with worse credit histories. That big shift towards higher leverage lending between 2004 and 2006, that's a clear sign of this trend. And the quality control inside lending institutions, that seems to have gotten worse too. Subprime loans made later in the boom, like between 2006 and 2007, they had much higher rates of early delinquency, even after you factor in things like the borrower's characteristics and the overall economy.
The report also points to securitization as something that might have contributed to this weaker borrower screening.
This is an interesting idea. So, as more mortgages were being bundled up and sold off as securities, that's securitization. The companies making those loans, they didn't have as much of a long-term stake in how those loans performed. It's like, if you're going to sell the loan right away, you're not going to worry as much about whether the borrower can still pay it back in 10 years. One study showed that loans with FICO scores just above 620 had higher default rates. That 620 score, that was often the cutoff for securitization. So it looks like lenders might have been more focused on getting that score so they could sell the loan, instead of really looking at the borrower's ability to repay. Other research backs this up. It shows that the traditional models for predicting defaults, they got less accurate as securitization increased, especially for loans with less documentation. This separation of origination, servicing, and investment meant that no single entity had as much riding on the loan's success.
And it wasn't just that they were approving riskier borrowers. Even the rates at which loan applications were being denied, that started to show that standards were getting looser.
Yeah. Studies looked at data from the Home Mortgage Disclosure Act, or HMDA. They found that between 2000 and 2006, the rate of loan denials went down. And they couldn't explain that just by saying borrowers were getting more creditworthy. So it seems like lenders were just giving out loans more easily, even in areas and to people they might have said no to before.
Now, there's this common story about the foreclosure crisis, the idea of payment shock. That's when people's monthly payments jumped way up because they're adjustable rate mortgages, or ARMs reset to higher interest rates.
Yeah.
But the report has some evidence that goes against that being the main reason for those early defaults.
That's an important point. While payment shock definitely hurt a lot of borrowers, the evidence suggests that it might not have been the root cause of that initial wave of defaults. The report shows that early delinquencies were going up for both fixed-rate and adjustable-rate subprime loans. And on top of that, LIBOR rates, which is a benchmark for a lot of ARMs, those actually went down after September 2007. So in some cases, that would have made the impact of those rate resets less severe.
So the report is suggesting that a lot of those subprime loans were probably not sustainable from the very beginning, even before those interest rates adjusted.
Exactly. The fact that so many of those loans were just unaffordable when they were made, maybe because of high starting interest rates, prepayment penalties, or other bad terms, that seems to be a bigger problem than just the payment shock from ARMs resetting.
Okay, let's switch gears now. Let's talk about the bigger picture. The factors that created an environment where this risky lending could not only happen, but actually thrive deregulation? Or maybe it's more accurate to say the slow way that regulations were catching up to the changes in the market. That seems like a key piece of this.
Absolutely. The report highlights this big disconnect. The mortgage market was changing so fast. Non-depository lenders were popping up. Securitization was getting more and more complex, but regulations weren't keeping up. They were slow and often piecemeal. The focus on consumer disclosure rules, while important, it just wasn't enough to protect borrowers from these mortgage products that were getting more and more complicated. And the Homeownership and Equity Protection Act, or HOEPA, it was meant to stop predatory lending, but it ended up only applying to a tiny part of the whole mortgage market.
And then there was that preemption of state-level predatory lending laws by federal regulators that applied to federally chartered banks and their subsidiaries. That also seems like it limited consumer protection.
It did. That preemption meant fewer lenders had to follow those possibly stronger state-level protections, federal regulators. They were mainly focused on keeping the banking system safe and sound. But more and more mortgages were being made outside of traditional banks by independent mortgage companies that often had less strict federal oversight.
And the asset-backed securities market, that just exploded, didn't it? That really changed how mortgages were funded and moved around. It's kind of like bundling a bunch of individual mortgages together, then selling shares in that bundle to investors. That whole process, securitization.
It completely changed the game. The growth of the ABS market opened up this huge new source of money for mortgage lending, really allowed those non-depository institutions to take off. And the growth was incredible, from just $1.2 billion in 1985 to a massive $1.9 trillion by 2005.
And that change in how mortgages were financed, that had a big impact on who was actually making those loans.
Absolutely. The share of mortgages made by traditional banks, that went down a lot as more non-agency mortgage-backed securities were issued. And then there was this vertical disintegration. Think about a traditional bank. They handle the whole process, find the borrower, make the loan, manage the payments, and keep the loan on their books. Securitization broke all that up. One company might just focus on making the loan, another one bundles it into a security, a third company handles the monthly payments, and then another one buys the security as an investment. That separation meant no single entity had as much riding on whether the loan would actually succeed in the long run.
The report also talks about how credit rating agencies didn't have much federal oversight, even though they had so much influence on the market for mortgage-backed securities.
That's a crucial point. These agencies, they basically became the gatekeepers of the securities market because of their ratings. Investors relied heavily on those ratings. But the way they were paid by the companies issuing the securities. That's a clear conflict of interest.
Yeah.
And it probably led to them being too optimistic and often inaccurate about how risky those subprime mortgages and the securities based on them really were.
And what was happening in the global financial system, that played a role too, didn't it? International investors really wanted those asset-backed securities.
Yeah. Part of that was because of the big U.S. trade deficits. Global investors had all these dollars and they needed to invest them somewhere. So they wanted U.S. securities that offered higher returns. And then hedge funds. They were growing fast. They were hungry for complex investments that could potentially make a lot of money, all that demand, plus the belief that fancy financial tools like collateralized debt obligations, or CDOs, and credit default swaps, or CDS, those are even more complex things that basically repackage and insure different parts of those mortgage-backed securities. People thought those could protect investors from defaults. All of that just pushed risky lending practices even more.
In the end, the report says that the huge profits being made at every step of subprime lending and securitization, that was a major reason this market grew so much.
Definitely. There was so much money to be made by making packaging and selling these securities. Everyone involved had a strong incentive to keep it going, from the mortgage brokers to the big investment banks on Wall Street. And when you add in the competition between lenders, all trying to keep or grow their market share, well, that probably led to what's called a race to the bottom, meaning underwriting standards just kept getting worse and worse.
Now, let's talk about a few other things that often come up when people discuss this crisis. Mortgage fraud, the Community Reinvestment Act, or CRA, and the government-sponsored enterprises, or GSEs, like Fannie Mae and Freddie Mac. The report has some things to say about those, too. Mortgage fraud did go up, didn't it?
Reports of suspicious activity related to mortgage fraud. Those definitely went up after 2004. But it's always hard to know exactly how much fraud was really happening. The FBI, they usually separate for-profit fraud, which is often done by people in the industry like brokers, from for-housing fraud, which is done by homebuyers. They think most of it was for-profit. And that big increase in no documentation and low documentation loans, that seems to be linked to more fraud, especially in the alt-a-loan category. But in the end, the report's point is that lenders weren't strict enough with their underwriting. That created an environment where fraud could happen and often go unnoticed.
What about the CRA? Some people say it was a big part of the crisis.
The report actually disagrees with that. It says that the total amount of higher-priced loans made because of CRA requirements, that was actually pretty small. And those CRA-related loans, they actually had a lower risk of foreclosure compared to subprime loans overall.
And Fannie Mae and Freddie Mac, the GSEs, there's a lot of debate about their role in all of this.
The report says that while the GSEs did end up with a lot of risky mortgage-backed securities, it seems like they got into the subprime market mostly because they wanted to keep up with the competition and keep making money. Not just because of rules about supporting affordable housing, while they did buy a lot of subprime mortgage-backed securities, which gave that market more money. It's important to remember that the demand from GSEs actually went down, even as the overall subprime market kept growing.
As the crisis was starting and foreclosures were going up, there were some early attempts to limit the damage.
Right.
Programs like FHA Secure and Hope for Homeowners. How well did those work at the beginning?
The report says those programs didn't have much success at first. Part of that was because a lot of homeowners who were struggling, they didn't meet the requirements to be in those programs. And for Hope for Homeowners, some lenders just weren't that interested in participating. But there was definitely growing pressure from the public for more loan modifications. People wanted to see lenders doing more to help.
And those early loan modifications, they often didn't really fix the problems that homeowners were facing.
True. A lot of those early modifications didn't lower monthly payments that much. And sometimes they even made the borrower's total debt bigger. So it's not surprising that a lot of those loans ended up defaulting again. The real problem, the fact that people couldn't afford the loans, that wasn't being addressed.
And that leads us to the Home Affordable Modification Program, or HAM. What was the main goal of that program?
HAMP.
Yep.
It was all about lowering monthly payments to a level that homeowners could manage. They usually aimed for a payment that was no more than 31% of the borrower's income. The program mainly did this by subsidizing lower interest rates. And in some cases, it let people reduce their principal. But the report says that some mortgage servicers, they didn't want to offer big interest rate cuts or principal reductions. Part of that was because they were worried about the agreements they had with the investors who owned those mortgage-backed securities.
So they designed HAMP to try to get around those roadblocks and to encourage more effective loan modifications.
Yeah. They offered financial incentives to servicers, like subsidies for modifications that worked, and bonus payments for hitting certain targets. And they gave clearer instructions on how to interpret those complicated pooling and servicing agreements. They hoped it would get more servicers to use loan modification tools that actually made a difference, lowering borrowers' monthly payments in a way that would last.
Finally, the report talks about some of the ideas for bigger regulatory changes that were being discussed. Things that could prevent a crisis like this from happening again. What were some of the main proposals?
One big idea was to create a new powerful agency, the Consumer Financial Protection Agency. It would have broad authority to protect consumers from unfair, deceptive, or abusive practices across the whole financial industry. That included the power to make stronger and simpler rules about disclosures for mortgage products. There was also agreement that the whole regulatory structure needed to be improved. People wanted to see more uniform regulations for the whole mortgage industry, including those non-bank lenders that had become so important. Some even suggested applying something like the Community Reinvestment Act to those non-bank lenders. And finally, everyone agreed that the secondary mortgage market needed much better regulation, especially the private label mortgage-backed securities markets and the credit rating agencies. One idea was to make originators and issuers keep a financial interest in the loans they were securitizing.
So as we wrap up this deep dive, it's pretty obvious that the foreclosure crisis wasn't a simple thing with one single cause. It was a really tangled web of different factors.
Exactly. It wasn't just about house prices going down or borrowers being predatory or one specific failure in regulation. It was this dangerous mix of risky lending practices becoming the norm, regulations that couldn't keep up with the changes, and market incentives that pushed for short-term profits instead of long-term stability in the financial system.
And understanding all this history, it really gives us a better perspective on how financial markets work and the importance of regulation. Even today, the debates we're having now about financial stability and consumer protection, they're shaped by the lessons we learned from this period.
And that brings up an important question for you to think about, considering everything we've talked about. The risky loans, the weaker underwriting standards, the gaps in regulation, all the market pressures. If you could go back in time, what one regulatory change or market shift do you think could have prevented the crisis from becoming as bad as it did? And maybe even more importantly, why do you think that change would have been so effective? It really makes us think about that balance between encouraging innovation in finance and making sure there's enough oversight to manage the risks that come with it.
That's a great question to end on. We'd love to hear what you think. Let us know in the comments below.
Thanks for joining us today. It's been great taking this deep dive with you.
Until next time.
Take care.
Bye.